Welcome to Inside Corporate Finance, where we unpack the tools and frameworks that drive financial performance and strategic decisions. Today, we're diving into one of the most powerful and widely used tools in finance, financial ratios. From liquidity and solvency to profitability and efficiency, these metrics are essential for evaluating a company's financial health and making informed decisions. But before we begin, if you'd like to receive a free ebook summarizing the most important financial ratios, including definitions, formulas, interpretation tips, and benchmarking techniques, here's what you need to do. Like this episode, share it with your network, leave a comment below, and we'll reach out to send you the ebook directly, free of charge. Now, let's get into why benchmarking and trend analysis matter more than just numbers, how to apply a 4-step framework for ratio analysis, and how to use the DuPont pyramid to break down return on equity into key drivers. Whether you're in FP&A, corporate finance, or treasury, this is knowledge you'll use daily. Let's get started.
All right, so let's jump into this deep dive on financial ratios. You know, those numbers that can really help us understand the financial health of a company.
Yeah.
We're going to be really breaking down how these ratios go way beyond just being numbers, and they reveal so much about a company.
Absolutely.
Things like their profitability, their efficiency, and even their debt management strategies.
Mm-hmm.
And to guide us on this deep dive, we've got 2 really interesting sources.
Okay.
We've got a great guide from the Corporate Finance Institute and then a document outlining a bunch of common ratio calculations.
Sounds good.
And I think one of the things I'm really looking forward to in this deep dive is we're going to be comparing 3 retailers, a small, a medium, and a large retailer.
Okay.
To see how their different business approaches actually play out in the numbers.
I think that's a great way to illustrate it. It's amazing to me how much these ratios can tell you about the inside workings of a company.
Yeah, totally.
Especially when you're comparing different sizes or even different industries.
Yeah. Yeah, and I'm particularly intrigued by this this case of the mid-sized retailer. Because they seem to be punching above their weight in terms of profitability.
Interesting.
And I'm really curious to dig into that a little bit and see, is that actually sustainable? And what are some of the risks that might be associated with, that approach?
That's a great point. I think, a lot of times people see a single ratio and think that's the end-all be-all.
Yeah.
But you have to take into account a lot of things, the trends, potential risks.
Yeah.
And as you said, the industry context matters a lot.
Yeah, for sure.
So let's start with return on equity, ROE. It's a big one for investors.
Yeah, I've heard of that one.
Because it basically measures how much profit a company generates with the money that shareholders have invested.
Okay, that makes sense.
So the higher the ROE, the better the company is at using the investors' money to create profit.
Right, yeah.
It's a measure of efficiency with the investment.
So a higher ROE generally means that the company is making good use of those funds, right?
Exactly.
But I think you touched on something really important. That context is super important here.
Absolutely.
What's considered a good ROE can vary a lot.
Yes.
Depending on the industry, right?
Absolutely. If you think about industries that require a lot of capital to operate, like utilities or telecom, those are going to naturally have lower ROEs than industries that require less capital, like tech or pharmaceuticals.
Right, makes sense.
You're not going to compare a retailer's ROE to a tech company's.
Yeah.
It's not a fair comparison.
Totally. So you need to compare apples to apples, essentially.
Yeah, exactly. It's crucial to consider the industry benchmarks when you're evaluating these ratios.
Okay, yeah, that's making a lot more sense to me now.
Good.
So back to our retailers then, what is their ROE telling us about those businesses?
So this is where things get really interesting.
Okay.
That mid-sized retailer you mentioned, well, their average ROE over the past 5 years has been more than double the industry average.
Wow.
So they're really outperforming their peers.
That's impressive.
It is. But here's where it gets even more intriguing.
Okay.
They've achieved this with lower gross margins than their competitors.
What?
Yeah. So that means they're doing something unique and potentially very smart.
So lower margins, but higher ROE. How does that even work?
Right. It definitely raises some questions.
Yeah.
Could it be their business model? I know they've been really aggressively expanding.
Yeah.
With those big warehouse-style stores.
Yes.
In less expensive locations.
Yeah. So maybe it's their real estate strategy.
Exactly. Their focus on cost-efficient real estate could definitely be a key factor in their impressive ROE.
Okay.
Plus, they're known for running a very tight ship.
Really?
When it comes to operating expenses, which further boosts their profitability.
So they're not just being smart with shareholder money, they're also being efficient with their overall operations.
Exactly. They're maximizing returns on multiple fronts.
But, and I hate to be a downer here, but could there be a downside to this strategy? Like, is it all sunshine and rainbows?
You're right to question that,
Oh.
There's always a flip side to every coin.
Yeah,
And investors always need to consider the potential risks as well as the rewards.
totally.
Operating on thinner margins might make them vulnerable to certain things.
Okay.
Like, what if there's a sudden economic downturn?
Right.
Or if the cost of their inputs suddenly increases?
Yeah, for sure.
So high ROE doesn't automatically guarantee smooth sailing.
Right, there's always these trade-offs.
Exactly. There's always trade-offs and potential risks to think about.
Okay, I get it. It's not as simple as just looking at one number and saying, oh, this company is doing great.
Exactly. Financial analysis is all about peeling back the layers and considering the bigger picture.
So what's the next layer of the onion, so to speak? What other ratio should we be looking at?
Let's move on to return on assets, or ROA.
Okay, ROA.
This one's interesting because it looks at how efficiently a company uses all its assets to generate profit. And that's regardless of how those assets are financed.
So this gives us a broader view than just looking at ROE.
Absolutely. It takes into account both debt and equity.
Oh, interesting. Okay.
Well, it gives you a more holistic perspective on the company's operational efficiency.
So I imagine this can reveal different insights compared to ROE, which is just focusing on the shareholders. Right?
Exactly. You could have two companies with the same ROE, but one might have a lot of debt while the other might rely more on equity financing.
Right.
And ROA would help us see that difference.
Okay, that makes sense.
It adds another layer of understanding.
Right, adds more nuance to it.
Mm-hmm.
So what does ROA tell us about our three retailers then?
So for the mid-sized retailer, their ROA has been consistently strong over the past 5 years.
Okay.
And it kind of mirrors their impressive ROE performance.
Okay, so they're doing well on both.
Yeah, which really reinforces their strong operational efficiency,
Okay.
regardless of their financing choices.
So they're really good at using their assets to make money, basically.
They're very efficient, yeah.
What about the other two? What about the large and small retailers? How do they compare?
So the large retailer has actually seen their ROA trending downwards over the past 5 years,
Oh, interesting.
which again mirrors their declining ROE.
Oh, okay.
So that kind of suggests there might be some underlying issues with their operations,
Okay.
Impacting their ability to really generate returns from their assets.
That downward trend definitely sounds like something to look into.
Definitely a yellow flag, yeah.
What about the small retailer? Are they facing similar issues?
They have the lowest average ROA, similar to their low ROE,
Oh, okay.
which suggests they might be facing some challenges as well,
Okay.
maximizing the use of their assets to generate profit.
And is that potentially because they're, primarily operating in those more expensive urban areas?
That's a very likely factor, yes.
Mhm.
The higher operating costs associated with those locations could be playing a role.
Okay, so the mid-size retailer is in the lead so far for both ROE and ROA.
They are.
It seems like their focus on operational efficiency is really paying off.
Yeah, they're demonstrating a real knack for maximizing the use of their assets.
Now, before we move on to the next ratio, I'm kind of curious about ROA in general.
Sure.
What are some of the broader implications of this ratio? How does it play out across different industries?
That's a great question. So if you think about asset-intensive industries like utilities or manufacturing,
Okay.
they typically have lower ROAs
Okay.
compared to sectors that have lower asset intensity like software or services.
Yeah, makes sense.
Companies with fewer physical assets often have lower operating costs and can achieve higher margins, which boosts their ROA.
Yeah, the less you have tied up in physical stuff,
Yeah.
the more nimble and potentially more profitable you can be.
Exactly. It's about optimizing your resources for maximum return.
Okay, I'm starting to see the bigger picture here. So we've talked about ROE, ROA. Now, is there another return ratio that we should be considering?
Yes. We should also talk about return on invested capital, or ROIC.
ROIC, okay.
So unlike ROE, which only considers equity, ROIC takes into account both debt and equity financing.
Okay.
So it's giving you a more comprehensive view of how well a company is using all of its available capital.
Right. So it's not just how well are they using the shareholders' money, but all the money that they have at their disposal.
Exactly. It's a more holistic measure of capital efficiency.
Okay, got it. So how does our mid-sized retailer stack up when we look at ROIC?
Well, as you might have guessed, they once again have a significantly higher ROIC.
No surprise there.
Right.
And
They're consistently exceeding expectations.
okay.
And their ROIC is well above the industry average, too, which really demonstrates their ability to effectively deploy both debt and equity capital to generate strong returns.
Yeah. They're making a very compelling case for being like a really smart and efficient company.
Absolutely.
So we've got ROE, ROA, ROIC. How do we know which one to use when we're analyzing a company? Like, are they all equally important or?
Well, that's the key to financial analysis, right? Choosing the right tool for the job.
Okay, yeah.
So ROE is really good for looking at the returns specifically for shareholders,
Okay.
whereas ROA focuses on the overall asset efficiency.
And ROIC?
ROIC gives you a broader perspective, considering both debt and equity financing.
Okay, so each ratio is telling us something slightly different.
Exactly.
And it's about understanding those nuances. Right?
Absolutely. It's not just about crunching the numbers. It's about knowing what the numbers actually mean.
Yeah, that makes total sense. So we're not just number crunchers here.
No, we're financial detectives.
I like that.
Uncovering the story behind the numbers.
Okay, so we've got a good grasp on the return ratios. Now, are we ready to move on to the next category of ratios?
Let's dive into profitability ratios. These ratios focus on how much profit a company generates from its sales.
Okay, profitability ratios.
We'll look at gross margin, operating profit margin, and net profit margin
All right, sounds good.
to see how effectively companies convert those sales into actual profit.
All right, I'm ready to explore those profit margins.
Great. Let's start with gross margin. This measures the profit a company makes after paying off the direct costs
Okay.
of producing or acquiring the goods that they sell.
So, like, their raw materials.
Exactly. So essentially, gross margin reveals how efficiently they manage their production or their sourcing process.
Okay, so it's about how much they're keeping from each sale after covering those costs.
Precisely.
So a higher gross margin means they're keeping more money from each sale after covering those initial costs, right?
That's the gist of it, yes.
So it sounds pretty straightforward.
It is on the surface.
Okay.
But remember, even within the same industry, gross margins can vary widely
Oh, interesting.
because they reflect different pricing strategies and cost control measures.
Yeah, okay, that makes sense.
So you can't just look at a gross margin in isolation.
Right.
You need to consider the company's overall strategy and how they position themselves in the market.
Okay, so what's the story with our retailers' gross margins?
Okay, so this is where things get interesting again.
Oh, good.
Remember our mid-sized retailer,
Uh-huh.
the one with the stellar ROE, ROA, and ROAC?
Yeah, the overachiever.
Well, they actually have the lowest gross margin.
What?
Yeah.
Seriously?
Yes, which suggests they might be using what's called a cost leadership strategy,
Okay.
where they offer lower prices
Okay.
to attract more customers.
So they're sacrificing some profit on each individual sale,
Potentially, yes.
but they're making up for it with higher volume and then overall efficiency.
Exactly. They're playing the volume game.
Wow, that's a really different approach.
It is, and it seems to be working for them so far.
Yeah. What about the large and the small retailers? What are their margins looking like?
So they both have higher gross margins,
Okay.
closer to each other,
Yeah.
which implies a more traditional approach to pricing.
Okay, so different strategies at play here.
Mhm.
Interesting.
Even within the same industry, you can see a wide range of approaches to gross margin.
Yeah, totally.
It all depends on the company's specific goals and how they choose to compete.
All right, so gross margin, check. What's the next profitability ratio we need to understand?
Okay, let's talk about operating profit margin.
Operating profit margin. Okay.
This tells us how much profit a company makes from its core operations
Okay.
before taking into account interest and taxes.
So it's like their profit from their actual business activities.
Precisely. It reflects how efficiently they're managing their overall operating expenses.
So it gives us a picture of the profitability of their core business before factoring in those financing costs and taxes.
Exactly. It's a way to isolate their operational efficiency.
Okay, that makes sense. What insights does operating profit margin offer when we look at our retailers?
So this is where things get interesting again.
All right, lay it on me.
Even though the retailers started out with very different gross margins,
Yeah.
when we look at their operating profit margins, they all fall within a fairly narrow range.
Oh, really?
Yeah. The mid-sized retailer's margin is actually quite close to the other two.
So even though they're making less profit per sale, it seems like they're really good at controlling their operating expenses.
You got it. They might be really good at managing things like selling, general, and administrative expenses.
Okay, yeah. That all adds up.
Right. It shows that efficiency goes beyond just the cost of goods.
Totally. It's about running a tight ship overall.
Exactly. And it seems to be a key factor in their overall success.
That's really impressive. What about the other two retailers? Any notable trends there?
So with the large retailer, we're again seeing that downward trend.
Oh, no, not again.
Yeah, that same pattern we saw with ROE and ROA.
Okay, so their operating profit margin is also declining. That's definitely a red flag.
It's something that would definitely warrant further investigation.
Okay, we'll add that to the list of things to dig into later.
All right.
Now, let's talk about that final profitability ratio, net profit margin. What's the deal with that one?
Okay, so net profit margin is the bottom line.
Okay.
It's the percentage of revenue that actually translates into profit for the shareholders.
No.
After all expenses have been paid, including interest and taxes.
So it's the real deal, the money that's actually going back to the owners of the company.
Exactly. It's the ultimate measure of profitability.
Okay, got it. So what story does net profit margin tell us about our retailers?
Well, despite their different paths to get there, it looks like they've all converged,
Okay.
with all three retailers delivering net profit margins that are pretty close to the industry average.
So they're all ending up at a similar destination, even if they took different routes.
Precisely. It's fascinating to see how different strategies can lead to similar outcomes.
It is. But it's also important to remember, right, that retailers in general tend to have low net profit margins
Yes.
compared to other industries like software companies or luxury brands, right?
Exactly. Those industries can command much higher margins.
Yeah, those razor-thin margins in retail are always a challenge.
They are. It's a highly competitive market.
So once again, context is key.
Absolutely. You can't judge a retailer's net profit margin by the same standards as a software company.
Okay, it's all about those apples-to-apples comparisons.
Exactly. It's about understanding the nuances of each industry.
All right, so we've got a good grasp of return and profitability ratios. Now, I think it's time to take a quick break.
That's good.
We'll be back in a moment to continue our deep dive. Okay, so welcome back. We just finished talking about return and profitability ratios.
Yeah, those were really insightful.
They were. And now we're going to shift gears a little bit and dive into something called asset utilization ratios.
Okay.
And these ratios highlight how efficiently a company uses its assets to generate revenue.
Right. It's not just about making a profit.
Exactly.
It's about making the most of the resources that you have available.
Right. So it's kind of like, you've got this toolbox full of tools.
Yeah.
How effectively are you using those tools to get the job done?
That's a great analogy.
Yeah.
You want to make sure you're not just letting those tools sit there gathering dust.
Exactly. You got to put them to work.
Absolutely. Asset utilization ratios, sometimes called efficiency ratios, give us a really good look at how a company's managing its working capital
Okay.
and how well it's turning its assets into sales.
Okay. So it's about getting the most bang for your buck, essentially.
You got it. It's a crucial part of a company's overall financial health.
Right. So let's break down some of these key asset utilization ratios. Where should we start?
Well, there are a bunch of them, but we're going to focus on what I call the top 6.
Okay, top 6.
So we'll be looking at total asset turnover, property, plant, and equipment, PP&E, turnover, cash turnover in cash days, accounts receivable turnover in days, inventory turnover in days, and then finally accounts payable turnover in days.
Okay, so that's quite a lineup.
It is, but we'll take it one step at a time.
Okay, good. Let's start with total asset turnover.
Okay.
What exactly does that tell us?
So total asset turnover basically measures how efficiently a company uses all of its assets to generate sales revenue. It tells you how many dollars in revenue are produced for every dollar of assets that they have.
Okay.
So for example, if a company has a total asset turnover of, let's say, 1.5,
Okay.
that means they're generating $1.50 in revenue for every $1 of assets.
Okay, that makes sense.
Yeah.
So a higher total asset turnover ratio means they're getting more revenue out of their assets.
Exactly. It's about maximizing efficiency.
All right, so efficiency is the name of the game. I'm curious to see how retailers are doing when it comes to this ratio.
Well, it's interesting because you see a clear distinction between the three, which points to different strategies for managing their assets.
Okay, I'm intrigued. Which retailer is winning the efficiency race here?
Once again, the mid-sized retailer is leading the pack.
Of course they are.
I know, right? They're really impressive.
They've got the magic touch, it seems.
They do. They have the highest total asset turnover, followed by the large retailer, and then the small retailer.
Okay, so they're not just profitable, but they're also super efficient at using their assets to generate sales. What's driving this efficiency? Is it their store model with those warehouse-style stores?
You nailed it. Their focus on cost-efficient real estate plays a huge role.
Okay.
Those big warehouse-style stores located in those less expensive areas allow them to generate more revenue per dollar invested.
Right, because their real estate costs are lower.
Exactly. They've really got their real estate strategy down pat.
Yeah, they've figured out the formula. It's amazing how, like, a strategic approach to real estate can ripple through a company's financials and really impact their efficiency.
Yeah.
So what about the other two? Are they lagging behind because of less efficient real estate strategies?
Well, the large retailer, which has a mix of urban and suburban stores,
Right.
kind of falls somewhere in the middle,
Okay.
probably reflecting the varying costs associated with those locations.
Makes sense.
And then the small retailer, mainly operating those expensive urban areas,
Yeah.
has the lowest total asset turnover.
So location, location, location.
It's classic for a reason.
Okay, so that was total asset turnover. Now, what about this property, plant, and equipment, PP&E turnover? Is that similar?
It is PP&E turnover focuses specifically on how efficiently a company uses its property, plant, and equipment
Okay.
to generate sales.
So that's things like buildings and machinery.
Exactly. And since PP&E often represents a big chunk of a company's assets,
Okay.
the PPE turnover ratio usually moves pretty much in line with the total asset turnover ratio.
Okay, that makes sense. So we should see similar patterns with our retailers, right?
You would think so, and you'd be right. Our mid-size retailer with those efficient warehouse-style stores boasts the highest PP&E turnover as well.
No surprise there. They're just killing it.
I know. They're really good at squeezing the most out of their assets.
So they're generating more revenue per dollar invested in their buildings and equipment compared to the other two?
Exactly.
And the large and small retailers. Are they following the same pattern as with total asset turnover?
Yep. Large retailers in the middle, small retailer has the lowest PP&E turnover.
Okay, so the trends are consistent.
Consistent across the board.
Okay, great. So the mid-sized retailer is still reigning supreme in the efficiency department. Now, what about these cash turnover and cash days ratios? Those sound interesting.
Yeah, these are really important because they give us a look at how well a company is managing its cash flow.
Okay, cash flow is king, right?
It really is. So cash turnover tells you how many times a company's cash balance cycles through during the year,
Okay.
generating revenue.
Okay, so it's like how many times are they turning over their cash to make sales?
Exactly. For example, if a company has a cash turnover of 10,
Okay.
that means their average cash balance is generating revenue 10 times a year.
Okay, so the higher the cash turnover, the better.
Generally speaking, yes.
Okay.
A higher ratio usually indicates that the company is using its cash effectively to drive sales.
Makes sense. Now, what about cash days? How does that relate to cash turnover?
So cash days looks at it from a slightly different angle. It tells you how many days it takes for a company's cash balance
Okay.
to be converted into sales.
Okay, so a lower number for cash days means they're turning their cash into revenue more quickly.
You got it. It's all about speed and efficiency.
So what do these ratios tell us about our retail superstars? Are they holding onto their cash for too long, or are they putting it to work quickly?
So this is interesting because when you look at their cash days, they might seem incredibly low,
Okay.
but it actually makes perfect sense when you think about their business model.
Okay, enlighten me. Why are their cash days so low?
Well, think about what they sell. Everyday necessities.
Food, clothes, household stuff.
Exactly. People are buying these things constantly.
Right.
So the cash is flowing in daily,
Okay.
which allows these retailers to operate with relatively low cash balances and still have healthy cash flow.
Okay, that makes sense. They don't need to hoard cash because they have a steady stream coming in.
Precisely. They're constantly replenishing their cash reserves through those everyday sales.
Okay, so it's all about the nature of their business.
Yeah.
But what about businesses that don't have that luxury of consistent daily sales? Wouldn't they need to manage their cash differently?
Absolutely. Businesses with seasonal demand or those that are in the early stages of growth,
Okay.
they often need higher cash balances just to navigate those periods of lower revenue.
Right. They need a cushion.
Exactly. Think about a company that sells holiday decorations
Okay.
or a tech startup that's still burning through cash to develop their product.
Right. Their cash needs are completely different.
Totally different. Their cash management strategies need to reflect those unique challenges.
Okay, so yet again, context matters when we're interpreting these ratios.
Always.
We can't just apply the same benchmarks across the board.
Yep. Every industry has its own quirks and factors that influence those ratios.
Okay. I'm really starting to see the importance of understanding those industry-specific factors. Now, let's move on to those accounts receivable turnover and days. What are those all about?
Okay, so accounts receivable, or AR, represents the money that a company is owed by its customers.
Okay, so it's like they've delivered the goods or services, but they haven't been paid yet?
Exactly. AR turnover tells you how quickly a company collects those outstanding payments.
So the faster they collect, the better.
Right. Generally, yes.
Mm-hmm.
A higher AR turnover usually means they're managing their collections efficiently.
Okay, so they want to see that money coming in as soon as possible.
Exactly. They don't want to be waiting around for payments.
Now, what about AR days? Is that just the opposite of AR turnover?
It is. AR days tells you the average number of days it takes to collect payment from those customers.
So a lower number for AR days means they're getting paid faster.
You got it. It's all connected.
All right, so what do these ratios reveal about our retail dynamos? Are they chasing down late payments or are they getting paid promptly?
Well, as you might expect, for retailers who are typically receiving immediate payment.
Right, people are paying for their groceries right away.
Exactly. Their AR days are incredibly low, practically zero.
Yeah, it's not like people are putting groceries on layaway or anything.
Right. It just doesn't work that way in the retail world.
But I imagine there are industries where AR days could be much higher, right?
Oh, absolutely. Think about businesses that sell big ticket items or services.
Okay, like construction companies or consulting firms.
Exactly. They often extend credit to their customers,
Right.
which results in longer payment terms and therefore higher AR days.
So the nature of the business really impacts those ratios.
It's a crucial factor to consider.
All right, so we've got AR turnover and days covered.
Yeah.
Now let's talk about inventory turnover and days. What's the scoop on those?
Okay, so inventory turnover tells you how efficiently a company manages its inventory.
Okay.
It measures how quickly they're selling their products
Okay.
and replenishing their stock.
So it's about finding that sweet spot between having enough inventory to meet demand, but not having too much that it just sits there.
Exactly. It's a delicate balance.
Right, because holding on to too much inventory can tie up a lot of cash, right?
It can. And that cash could be used for other things, like investing in growth opportunities.
So efficient inventory management is all about striking that balance.
It really is.
Now, what about inventory days?
So inventory days, like the other days ratios, tells you the average number of days it takes a company to sell its inventory.
Okay, so a lower number means they're turning over their inventory more quickly.
Exactly. It's a measure of how fast those products are flying off the shelves.
So what are our retailers' inventory days looking like? Are they holding on to their inventory for ages, or are they moving it quickly?
Their inventory days are relatively low and stable,
Okay.
which is expected for businesses that are selling everyday necessities.
Yeah, they need to keep those shelves stocked.
Exactly. Imagine going to the grocery store and finding empty shelves.
That would be a nightmare.
It would. So they need to replenish their inventory constantly.
Okay, so they can't afford to have slow-moving inventory. But I imagine different retailers might have very different inventory days depending on the types of products they sell, right?
Of course. For example, a car dealership would probably have much higher inventory days than a grocery store.
Yeah, that makes sense. Cars are big-ticket items that take longer to sell.
Exactly.
Mm.
And grocery stores are dealing with perishable goods that need to be sold quickly.
Right, you don't want to see a month-old carton of milk on the shelf. Okay, so the type of inventory really matters when we're looking at those ratios?
It absolutely does.
All right, we're on the last one. Tell me about accounts payable turnover and days. What do those tell us?
Okay, so accounts payable, or AP, represents the money a company owes to its suppliers.
Okay, so it's like they've received the goods or services, but they haven't paid for them yet.
Exactly. And AT turnover measures how quickly the company is paying those suppliers.
Okay, so it's about managing their outgoing payments.
Exactly. And a higher AP turnover usually means they're settling their bills faster.
Okay, so it sounds like a higher AP turnover is a good thing. They're not letting those bills pile up.
Right, but there's a little nuance here.
Okay, what's the catch?
While prompt payment is generally viewed as a positive thing, a very high AP turnover could actually mean that a company's missing out on some opportunities to optimize their cash flow.
Oh, interesting. So sometimes it might be better to hold on to that cash a little longer?
Sometimes, yes. Strategically extending payment terms can be beneficial.
Okay.
Especially if it aligns with industry norms and their agreements with suppliers.
So it's about finding that balance, right?
Exactly.
Yeah.
You want to maintain good relationships with your suppliers.
Right. Keep them happy.
Exactly. But you also want to make the most of your cash flow.
It makes sense.
Yeah.
So what do these ratios reveal about our retailers? Are they paying their suppliers on time or are they dragging their feet?
Okay, so this is where things get really interesting again.
All right, I'm ready for some juicy insights.
The small and the mid-sized retailers have AP days that are fairly close to the industry average.
Okay, so they're kind of in the middle of the pack.
Yeah, they're following a pretty typical approach to managing their payments.
Okay, makes sense.
But then you have the large retailer.
Okay, what are they doing?
They have significantly higher AP days.
Oh, really? So they're taking longer to pay their suppliers?
They are. But this might not be a bad thing.
Okay, I'm listening.
It could actually be a sign of their strong negotiating power.
Interesting. Tell me more about that. How does their size give them negotiating power?
Well, large retailers often have more leverage when they're negotiating payment terms with their suppliers.
Okay.
Simply because of their size and the volume of their purchases.
Right, they're a bigger fish.
Exactly. They might be able to secure longer payment periods, which allows them to hold on to their cash for a longer time.
So it's not that they're being inefficient with their payments, it's more like they're using their market power strategically.
Exactly. They're leveraging their scale to optimize their cash flow.
That's pretty savvy. So we've covered a lot of ground here with asset utilization ratios.
We have. We've looked at how efficiently these companies are managing their working capital.
From their cash to their inventory to their accounts payable.
It's all connected. And as we've seen, it's not just about looking at those numbers in isolation. It's about seeing how they all fit together to tell a story about the company's overall financial health.
Okay, so we're starting to connect the dots and see the bigger picture.
Exactly.
Yeah.
And again, remember that industry context is super important when you're interpreting these ratios.
Right, those industry benchmarks are key.
They are.
Okay, so are we ready to move on to the next category of ratios, which I think is solvency ratios?
Yes. Let's dive into solvency ratios next. These ratios will give us a good understanding of how well a company can handle its debt.
Okay, so we're going to see how much debt they have and how well they're managing it.
Exactly. Because debt can be a powerful tool for growth, but it's also important to make sure it's not getting out of control.
All right, let's dive in and see what we can uncover.
Yeah.
Okay, so debt. It can be kind of a scary word for some people.
Yeah, it definitely has a bit of a negative connotation.
Yeah. But, for a lot of businesses, debt is like an essential tool
Absolutely.
for growth and expansion.
It's how they finance big projects or acquisitions.
Right. It can be a way to really scale up their operations. So I'm eager to explore these solvency ratios and see what they can tell us about a company's ability to handle their debt obligations. Because, if you take on too much debt, things can get pretty messy pretty quickly, right?
Oh, absolutely. Solvency ratios are all about assessing that long-term financial health.
Okay.
And understanding a company's capacity to meet those debt obligations.
Right, because you've got those interest payments looming.
Exactly. And those can really become a burden if a company isn't careful.
Especially in times of economic uncertainty or if interest rates start rising, right?
Yeah, those factors can really put a strain on a company's ability to service their debt.
Okay, so which solvency ratios are we going to be focusing on today?
We're going to delve into 4 key ratios: total assets to equity, debt to equity, debt to tangible net worth, and then debt to EBITDA.
Okay, those sound pretty comprehensive.
They are. Each one gives you a slightly different perspective on a company's leverage.
Okay.
And how well they're managing that debt load.
All right, let's start with total assets to equity. What does that one tell us?
So total assets to equity gives us a good overview of how much of a company's assets are financed through debt compared to equity.
Okay.
It's kind of like a high-level gauge of their reliance on debt financing.
Okay, so the higher the ratio, the more debt they have relative to equity. Is that always a bad thing?
Not necessarily. Debt can be a really powerful tool for growth.
Okay.
But you have to remember that it also comes with risks.
Okay, yeah.
A higher level of debt can amplify gains, but it can also amplify losses.
Right.
So it makes a company more vulnerable if there's an economic downturn.
Okay, so it's about finding that balance, right? Not too much debt, but enough to fuel growth.
Exactly. It's a delicate balancing act.
Now, you mentioned earlier that the total assets to equity ratio doesn't give us the complete picture of a company's debt.
That's right. It's a good starting point.
Okay.
But it's important to dig a little deeper.
Okay.
Because this ratio doesn't differentiate between different types of liabilities.
Okay.
Some of which might be less risky than others.
So we need to look at it in conjunction with other ratios.
Absolutely. And that's where the debt to equity ratio comes in.
Okay, debt to equity. So this one gives us a more focused view.
It does. It specifically compares a company's total debt to their shareholders' equity.
Okay, so it's really zeroing in on that debt portion of their financing?
Exactly. It's a very commonly used leverage ratio.
Okay, so what does the debt-to-equity ratio tell us about our retailers?
All right, so here's where things get a little interesting.
Okay, I'm ready.
The mid-sized retailer, despite their strong performance in those profitability and efficiency categories.
Yeah, they've been crushing it.
I know, right? Well, they actually have the lowest debt-to-equity ratio out of the three.
Oh, wow. That's surprising.
It is. And the small retailer actually has the highest.
Wait a minute. Didn't the mid-sized retailer have the highest total assets to equity ratio earlier?
They did.
So how can they now have the lowest debt-to-equity ratio? It seems a little counterintuitive.
That's a great observation.
Yeah.
And it highlights why it's so important to look at multiple ratios and understand what each one is actually telling you.
Okay. Yeah, I'm starting to see that.
Remember, total assets to equity includes all liabilities.
Right.
While debt to equity specifically focuses on that debt financing.
So it's possible that the mid-sized retailer has a higher proportion of other liabilities.
Exactly.
Like accounts payable, which wouldn't be factored into the debt-to-equity ratio.
That's right. So even though their overall liabilities might be higher, their actual debt level relative to equity is lower.
Okay, that makes sense. So they're not as heavily reliant on debt financing as we might have initially thought.
Exactly. And when you compare all three retailers to the industry average,
Okay.
they all actually have relatively conservative amounts of debt.
Okay, so they're not over-leveraged.
Nope. They're all within a healthy range, which is a positive sign.
Okay, that's good to hear. So now let's move on to the debt-to-tangible net worth ratio. What's special about this one?
So debt to tangible net worth adds a layer of conservatism to the analysis.
Okay.
It focuses on tangible net worth,
Okay.
which is basically the company's equity after you subtract things like intangible assets.
Tangible assets, so things like goodwill and patents.
Exactly. Things that are hard to put a precise value on
Okay.
and might not be easily converted to cash.
Right. They're not as solid as physical assets.
That's right. So this ratio gives you a more realistic picture of the company's ability to actually cover its debt with assets that are readily available.
So it's a more cautious approach.
It is. It's like looking at the company's debt situation with a more critical eye.
Okay, I like that. So when we apply this more conservative measure, what happens to our retailers' ratios?
Their ratios increase slightly compared to their debt-to-equity ratios.
Okay, so it's not a huge difference.
Not a huge difference, no. It just
Right.
indicates that they all have some intangible assets on their balance sheets.
Okay.
But it's not a significant amount.
Okay, so their debt levels are still looking pretty manageable.
They are. They're in a good spot.
Great. Now let's talk about that last solvency ratio, debt to EBITDA. Why is this one so popular with investors and lenders?
Debt to EBITDA is a favorite because it compares a company's debt to its earnings before interest, taxes, depreciation, and amortization.
Okay, that's a mouthful, Hebert.
It is, but it's a really important metric because it represents the cash flow from a company's operations
Okay.
before you factor in those non-cash expenses like depreciation.
So it's giving us a clearer picture of the cash they're actually generating to service that debt.
Exactly. It cuts through some of the accounting noise and focuses on the cash that's actually available.
Okay, so a lower debt to EBITDA ratio generally means the company is in a better position to make those debt payments, right?
Exactly. It means their cash flow is strong enough to handle those obligations.
All right, so what does this ratio tell us about our retailers?
Well, once again, the mid-sized retailer has the lowest leverage.
Okay, no surprises there. They're the golden child of this deep dive.
They really are. They're consistently outperforming the others.
What about the small retailer? Are they drowning in debt?
They actually have the highest debt to EBITDA ratio.
Okay.
But there's a silver lining.
Okay.
We see a clear downward trend in their ratio over the past 5 years.
Okay, so they're making progress in reducing their debt load.
They are, which is definitely a positive sign.
So the mid-sized retailer is demonstrating strong financial health, and the small retailer is moving in the right direction.
They are. And it's interesting to note that this debt to EBITDA ratio is often used in mergers and acquisitions.
Oh, really? Tell me more about that.
Yeah, so you'll often hear people talking about EBITDA multiples, which is basically just another way of expressing the debt to EBITDA ratio.
So, like, if a company has a debt to EBITDA ratio of 5, it means they're valued at 5 times their EBITDA.
Exactly. It's a quick way to assess a company's valuation relative to their cash flow.
Okay, that's really helpful to know. So we've covered a ton of ground here with these solvency ratios. We've learned how they can tell us about a company's debt levels, how well they're managing that debt, and even how they might be valued in a potential merger or acquisition.
And as we've emphasized throughout our discussion, context is everything.
Right. Those industry benchmarks are essential.
They are. You always need to consider the industry norms when interpreting these ratios.
Okay, that's a great point to remember. Now, before we wrap up this deep dive, I've heard about this interesting concept called the DuPont pyramid of ratios.
Oh, yeah, the DuPont pyramid. That's a good one.
Can we squeeze that in?
Absolutely. So the DuPont pyramid is a really powerful analytical tool that breaks down return on equity, ROE, into its core components.
Okay, so it's like we're taking ROE and dissecting it to see what's driving it.
Exactly. It's like a detective's toolkit for understanding financial performance.
I like that. I'm ready to put on my detector hat. Tell me more about this DuPont pyramid.
Okay, so the basic pyramid has 3 levels.
Okay.
You start with ROE at the top.
Okay.
And then you break it down into 2 main drivers: return on assets, ROA, and financial leverage.
Okay, so it's showing us how a company's profitability and their use of debt are both influencing ROE.
Exactly. And if you want to get even more granular, you can break down ROA further into net profit margin and total asset turnover.
Okay.
So that gives you a 5-level pyramid, which provides an even more detailed view of the factors that are driving that ROE.
So it's like we're peeling back the layers of the onion to reveal all the underlying drivers of a company's profitability.
That's a perfect analogy. And the beauty of the DuPont pyramid is that it really helps pinpoint those specific areas where a company might be excelling or struggling. So, is their high ROE being driven by strong profitability? Or is it because of a high level of leverage? Is there low ROE due to weak margins? Or are they just not using their assets efficiently? The DuPont pyramid can answer those questions.
Wow, that's super insightful. It really highlights how financial ratios give you a much deeper understanding than just looking at the raw numbers.
They do. It's like they provide a whole new language for understanding a company's performance and its potential.
Okay, so we've covered a ton of information today, from profitability to efficiency to leverage. We've learned how to calculate these ratios, how to interpret them, and most importantly, how to use them to gain those valuable insights into a company's financial performance.
It's been a great deep dive.
It has. We've seen how these ratios can help you compare companies within the same industry, identify trends over time, and even spot those potential red flags.
Those red flags are crucial for making smart investment decisions.
They are. So as we wrap up this deep dive, I want to leave our listeners with a little bit of homework. If you were analyzing a potential investment, which financial ratios would be at the top of your list, and why?
That's a great question. It really gets you thinking about what's most important to you as an investor.
Right, and there's no right or wrong answer. It depends on your individual goals and the specific industry you're looking at.
Exactly. The key is to understand the ratios and how to use them effectively.
Right. The more you know about these ratios, the better equipped you'll be to make those informed decisions. So keep exploring, keep learning, and remember, knowledge is power when it comes to the world of finance.
Absolutely. Financial literacy is crucial in today's world.
Well, thanks for joining us on this deep dive into financial ratios. We'll see you next time.